Welcome to the Opening Bell Report.
Welcome, everyone. I am so incredibly glad you decided to join us today.
Yeah, really great to be here.
If you are tuning in right now, you are probably someone who, loves getting to the bottom of things.
Avoiding all that market noise.
Exactly. Avoiding the noise and really understanding the underlying mechanics of how the financial world actually works. That is exactly our mission for this deep dive today.
It's a big one.
It really is. We have got this brand new, absolutely fascinating financial analysis report sitting on the desk between us.
And the data in here is just, it's mind-blowing.
It is. Our goal today is to break this analysis report down to explain a massive, sudden, and frankly historic shift that just occurred in the stock market. We're going to uncover the $11 billion reason Netflix stock just went parabolic.
It really is a masterclass in corporate evolution.
Yeah.
What we are looking at today is a textbook example of how service-level news can completely obscure the much deeper and arguably much more important financial reality of a company.
The actual fundamentals.
Right. The market just woke up to a profound structural change in the entertainment industry.
So let me set the scene for you. Imagine you opened up your investment portfolio or your favorite finance app this morning. You are scrolling through the usual tickers, checking the daily movements, and suddenly, boom, you see it.
Hard to miss.
Next to Netflix, ticker symbol NFLX, there's this massive, towering green candle on the chart.
A literal wall of green.
The stock didn't just have a mildly good day. It went completely parabolic. We are talking about a jaw-dropping surge of positive 13.77% in a single trading session.
Which is wild for a company of that size.
It ultimately closed at $96.24. For a mega-cap company the size of Netflix, a move like that is like watching a battleship suddenly accelerate like a sports car.
That's a great way to put it. To put that in perspective for you, a parabolic move in the market isn't just a gradual, steady climb.
Right.
It is a violent, almost vertical repricing event. It represents the market collectively realizing it has fundamentally mispriced an asset.
Everyone rushing in at once.
Exactly. It results in a stampede of institutional money rushing to get through the door at the exact same time. It practically defies normal financial gravity.
The buying pressure is so intense that sellers simply step out of the way.
They just vanish. But the real question you have to ask when you see a chart do that is, what triggered the stampede?
Okay, let's unpack this. Because if you look at the mainstream headlines right now, you will see one specific narrative dominating the news cycle.
The merger rumors.
Right. The alerts are all screaming that Netflix officially walked away from a rumored acquisition of Warner Bros. Discovery.
Which is true.
It is true, and it definitely served as the immediate catalyst for the jump. But this analysis report we are diving into reveals a completely different story.
A much deeper story.
The real driver of this institutional buying frenzy is actually buried deep in the fundamentals.
See, the headlines are entirely focused on the bullet that Netflix just dodged. But the analysis report highlights the absolute powerhouse of an engine that Netflix has built while no one was paying attention.
The $11 billion engine.
Exactly. There is an $11 billion reason why Netflix is currently leaving its legacy media peers completely in the dust. And it really rewrites everything we thought we knew about the economics of the streaming wars.
So we're going to pull back the curtain on the exact financial mechanics of how they pulled this off.
Let's do it.
But let's start with that headline catalyst, though, because it sets the stage perfectly for the underlying financials. According to the data in the report, for weeks leading up to this breakout, Netflix shares were basically trapped.
Consolidating.
Yeah, they were stuck in this frustrating sideways consolidation zone, bouncing between $75 and $84.
Just ping-ponging back and forth.
It was a total holding pattern. And the driving force behind that holding pattern was pure, unadulterated Wall Street fear.
Anxiety was running incredibly high among institutional investors. Netflix currently holds a very premium valuation compared to the rest of the market.
Which is a good thing, usually.
Usually, yes. But the overriding fear was that management was going to use that expensive stock as currency to go out and buy Warner Bros., Discovery, or WBD.
Which, on the surface, might sound like a media mega monopoly in the making.
Sure, it sounds great on paper.
You combine Netflix's distribution with WBD's legendary IP and movie franchises. So why was Wall Street so terrified of a deal that sounds like a content goldmine?
If we connect this to the bigger picture, acquiring WBD wouldn't just mean getting some great movie franchises.
Right.
It would mean inheriting billions upon billions of dollars in toxic legacy debt.
A massive anchor.
And even worse, it would mean chaining Netflix to the absolute dead weight of a rapidly declining linear TV business.
Jeeble.
Exactly. Cable. We have to remember that cable television is bleeding subscribers at an unprecedented rate.
And Netflix is the very company that started that bleeding.
The irony is rich, right? For Netflix to suddenly buy into the exact business model it successfully disrupted would would be a massive strategic regression. They would be buying a melting ice cube.
It makes me think of it's like house hunting. Imagine you see this gorgeous, historic fixer-upper house. It's got the glamorous columns, the beautiful wraparound porch.
The IP.
Right, the IP looks amazing. But then the inspector tells you the foundation is sinking, the roof is caving in, and the plumbing is a total disaster.
And it's going to cost you billions to fix.
Exactly. Sometimes dodging a bad purchase is way more valuable than making a good one.
Absolutely. So when Netflix officially killed that rumor and publicly walked away from the deal, the relief rally was instantaneous.
They confirm their commitment to a pure-play, high-margin streaming strategy rather than bailing out a sinking legacy ship.
Precisely. Dodging that massive structural headache was the immediate catalyst that caused the stock to gap up at the market open.
But the report goes deeper.
It does. As the analysis report wisely points out, simply avoiding a bad deal doesn't sustain a 13.77% move on its own.
Right, dodging a bullet gets you a sigh of relief.
It gets you a modest temporary bump. A parabolic sustained surge of this magnitude requires undeniable underlying business strength to keep the momentum going.
So investors aren't just rewarding what Netflix didn't do.
No, they are heavily rewarding what Netflix actually did.
Here's where it gets really interesting, because the analysis report pulls back the curtain on those core fundamentals, and it reveals a staggering bottom-line figure.
The big reveal.
We're talking about a record $10.98 billion in net income to common.
Just a massive number.
And just to be clear on the terminology here for you listening, net income to common means the actual hard profit left over for the everyday shareholders after all expenses, taxes, and preferred dividends are paid out.
The real bottom line.
The report rounds it up to our $11 billion headline, and honestly, when you are dealing with almost $11 billion in pure profit, you have earned the right to round up.
$10.98 billion. We really need to pause and appreciate the historical gravity of that number in the context of this company.
It's a total paradigm shift.
It is. For the better part of a decade, the overarching criticism of Netflix was that it was a cash-burning growth story.
Right.
Remember the zero interest rate era? They were spending wildly, taking on massive amounts of high-yield debt to fund original content like Stranger Things and House of Cards.
Just trying to acquire users at absolutely any cost.
Exactly. The bears on Wall Street constantly asked, sure, they have subscriber growth, but will this model ever actually generate real money?
The assumption was always that the content spend would forever outpace the subscription revenue.
That was the fear. Well, this $11 billion net income figure is the definitive, undeniable answer. The analysis report highlights a massive margin inflection.
Hey, flip the switch.
They did. Netflix has officially transitioned from that speculative, cash-burning growth story into a fully mature, highly optimized cash-printing machine. Their operating margins have now settled at a massive 29.5%.
Hitting a 29.5% operating margin is staggering for any company, let alone a media company.
It's unheard of in Hollywood.
That means nearly 30 cents of every single dollar they bring in is flowing straight through to operating profit, proving just how much leverage they've built into this model.
Incredible leverage.
But wait, I see the 29.5% margin in the report, but how does adding a cheaper ad-supported tier actually drive overall margins up?
That's a great question.
It feels counterintuitive to me. Wouldn't cheaper subscriptions drag the average revenue down? How does the math actually work there?
It brings us to the mechanics of what financial analysts call the profit waterfall and the distinct difference between fixed and variable costs.
Okay.
The analysis points to two specific levers management pulled: the password sharing crackdown and the rapid scaling of that ad-supported tier. To understand the math, consider their content spend.
Let's use an example.
Let's say Netflix spends $100 million to produce a massive blockbuster movie. That $100 million is a fixed content cost.
Right.
It costs the exact same $100 million to make the movie whether 10 people watch it or 10 million people watch it.
Okay, so the cost of the actual product doesn't scale up just because more people are consuming it.
Correct. And what this report makes clear is that Netflix's fixed content costs are essentially already covered by their massive existing base of legacy premium subscribers. I have already paid for the infrastructure. Therefore, when they introduce an ad-supported tier or when they force a password sharer to finally pony up a few dollars a month for their own profile, the costs to service those new streams of revenue are almost zero.
Because the movie is already made.
Exactly. Because the heavy lifting of the content production is already paid for, almost every single new dollar generated from ads or password crackdowns flows directly down the waterfall.
Straight to that $11 billion net profit line.
It is pure margin expansion.
That makes perfect sense. They are monetizing users on infrastructure that is already fully funded by the core user base.
Incredible operational leverage.
And that leverage is exactly what the market is aggressively pricing in right now. But we really can't fully grasp Netflix's current market dominance without looking at their rivals.
Competition.
Right. The report dedicates a significant section to the competitive moat, specifically framing it as Netflix crushing the legacy players, most notably Disney.
A tale of two companies.
Wall Street is currently throwing billions at Netflix, even though the stock has a PE, or price-to-earnings ratio, of around 38x.
To understand why a 38x PE is attracting so much institutional money, we have to look at the valuation gap. A PE of 38.07x might sound incredibly high in a vacuum.
Especially to a traditional value investor.
Oh, absolutely. But context is everything here. Historically, over the last 5 years, Netflix's average PE ratio has hovered around 43.5x.
Wow.
So despite this massive parabolic rally and the sheer sticker shock of the stock price, relative to its own historical baseline, Netflix is actually trading at a discount.
Then you look at Disney. The report points out that Disney, ticker symbol DIS, is currently sitting at a severely depressed PE ratio of about 15.5x.
Less than half.
Yeah, if you were a casual investor just screening for value, you might see Netflix at 38 and Disney at 15.5 and assume Disney is the obvious, cheaper value play.
Right.
But the analysis report argues the exact opposite. Why is the market happily paying a massive premium for Netflix while essentially penalizing Disney?
What's fascinating here is the market's underlying logic. Institutional money is not just looking at current earnings.
They're looking ahead.
They are looking at the quality, the visibility, and the trajectory of those earnings. The market happily pays a 38x premium for Netflix because its earnings are highly visible, predictably recurring, and rapidly growing.
Entirely fueled by that pure play streaming model we just discussed.
Exactly. The market knows exactly what it's buying. Disney, on the other hand, is being penalized. Its multiple is actively contracting because it is heavily burdened by the dying linear TV model.
The structural drag of cable.
Yes. Disney has incredible streaming assets, undoubtedly. But those assets are tethered to legacy cable networks that are losing viewers, losing crucial affiliate fees, and bleeding ad revenue every single quarter.
It's a tug of war.
They are stuck in a dual distribution nightmare trying to fund the expensive future of streaming while propping up the collapsing infrastructure of cable television.
It really is the streaming wars in a nutshell. You have the agile pure play tech company on one side, completely unburdened, and the traditional media empire on the other, dragging an anchor.
A very heavy anchor.
And the ultimate differentiator, according to the financial metrics in the report, comes down to cash flow dominance. This specific metric blew my mind when I read it.
It's the most important metric.
The report states that Netflix is generating $9.5 billion in free cash flow. They are converting a remarkable 21.0% of their top-line sales directly into cash.
Staggering.
And Disney's cash flow conversion rate sits at just about half of that, at roughly 10.7%.
Free cash flow is the absolute lifeblood of a company. It is the real, unencumbered money left over after a business pays for all its operating expenses and its capital expenditures.
Like funding new shows.
Funding shows, building studios, maintaining its global tech infrastructure. To convert 21% of your total revenue into cold, hard, free cash flow is an elite world-class metric.
It really is.
It means for every $100 of revenue that comes in the door, $21 goes straight into the war chest.
While Disney is only managing to capture about $10.70 of every 100.
Exactly. This dynamic gives Netflix a massive, insurmountable advantage in flexibility. They can vastly outspend their rivals on premium content without ever needing to touch debt markets.
Or they can use that cash to directly reward their shareholders.
Which is exactly what they're doing.
Speaking of rewarding shareholders, let's look at the forecast and where Netflix goes from here. The report breaks down the technical setup behind this parabolic move, pointing out that the price action created what analysts call a powerful island reversal bottom on heavy institutional volume.
For you listening, an island reversal is a very specific and typically very bullish technical chart pattern.
Yeah, I love chart patterns.
It is fascinating to see it play out on a mega cap stock. It happens when a stock gaps down in price, creating a literal empty space or gap on the daily chart trades in a tight, depressed range for a few days or weeks, forming an island, and then suddenly gaps violently back up above that range.
Like it's leaving all that bad sentiment behind.
Visually, it strands all those lower prices and anyone who shorted the stock down there on an island.
An island of regret?
Truly. When you see an island reversal accompanied by a heavy volume, meaning massive mutual funds and institutional investors are the ones doing the buying, it usually signals a major long-term shift in momentum.
So the technicals and fundamentals are agreeing.
The technicals on the chart and the fundamentals in the balance sheet are aligning perfectly here.
The report notes that the stock is now eyeing the psychological $100 resistance level.
A big round number.
And with those M&A fears completely gone with the Warner Bros., Discovery rumors, dead and buried. Analysts across Wall Street are basically tripping over themselves to revise their price targets upward.
They're all playing catch-up.
The street consensus implied a 12-month target of $111.81, with the most bullish analysts pointing all the way up to $151.40.
It is a profound shift in institutional sentiment. But the most important part of this forward-looking forecast isn't just the analyst price targets.
What is it?
It is the underlying mechanics of their capital return program.
So what does this all mean? What do they do with all that cash? You have $11 billion in net income, $9.5 billion in free cash flow. You're explicitly not buying a bloated legacy media company.
Yeah.
What is the secret weapon here?
The secret weapon is themselves?
Themselves.
Yes. They are using that massive $9.5 billion free cash flow pile to aggressively buy back their own stock, and we really need to elevate how we think about this. For the last decade, tech and growth companies survived by diluting their shareholders with massive stock-based compensation. They printed new shares to pay employees because they didn't have the cash.
Right. Dilution is usually the name of the game in tech.
Exactly. Netflix generating $9.5 billion in free cash flow and using it to actively retire shares off the open market signals a permanent graduation. They have moved from a speculative growth stock to a blue-chip value compounder.
That is a massive distinction.
It changes the entire investment thesis. Because the overall pie is now being sliced into fewer pieces, every remaining share you hold is suddenly worth a larger percentage of the company's total profits.
Which naturally drives the price up.
Furthermore, a consistent multi-billion-dollar buyback program provides an incredible floor for the stock price moving forward. If the broader market ever dips, the company is sitting right there with billions of dollars in cash ready to buy their own dip.
Which inherently supports the price.
It is the ultimate flex of financial maturity and a clear signal to institutional money that the era of dilution is over. That is what the big funds are actually buying.
It really is a completely new paradigm for them. To bring this all together, the bottom line summary of this entire analysis report is that Netflix isn't just winning the streaming war.
The war is largely over.
The war is over, the dust has settled, and Netflix has fundamentally altered its business model. They're operating in a completely different stratosphere, utterly detached from the structural struggles of legacy media companies that are still desperately trying to figure out how to transition away from the cable bundle.
That is exactly why understanding the mechanics of this deep dive is so crucial for you. What we are looking at is a real-time masterclass in corporate evolution.
It's rare to see.
It is incredibly rare to witness a business successfully navigate the treacherous transition from a high-burn, debt-fueled, hyper-growth disruptor into a dominant, high-margin, mature cash cow. Netflix has definitively proven through its balance sheet that their platform is no longer just a luxury entertainment add-on.
What is it then?
It is an unavoidable utility in global entertainment.
Unavoidable utility. That is the perfect phrasing. It really does feel exactly like that. You pay your water bill, your electric bill, your internet bill, and your Netflix bill.
It's just expected.
It is just a baseline, non-negotiable part of life now for hundreds of millions of people around the globe.
It is. And this raises an important question, something for you to mull over as we wrap up today's analysis.
Okay, let's hear it.
If Netflix's financials conclusively prove that it is no longer just a traditional media company, but an unavoidable utility like electricity or water for our digital entertainment, what happens next?
That's a huge question.
Historically, when a company becomes the sole utility in a given space and achieves this level of global market dominance, how long until it starts facing the kinds of strict regulations, pricing caps, and intense government scrutiny that traditional utilities face?
Oh, wow.
It is the heavy burden of absolute market dominance, and navigating that scrutiny might just be the next great challenge in the Netflix story.
Wow. That is a fascinating thought to leave on. When you become the utility, the rules of the game change entirely, and the moats you built suddenly become the very things regulators want to tear down.
Exactly.
Well, that brings us to the end of our breakdown. A huge thank you to you, the listener, for joining us on this deep dive into the analysis report today.
Thanks for tuning in.
We covered a lot of complex ground today, from the leverage of the profit waterfall to the psychology of island reversals. But hopefully you are walking away with a much clearer, deeper understanding of the $11 billion reason behind this historic market shift. Keep asking those big questions, keep seeking out those aha moments in the data, and we will catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.